for this week's edition of Stock Market 101, I figured that I would cover stop orders. So this has kind of come up quite a few times as it relates to stop losses, which is kind of the most common use for stop orders. But I figured I'd just kind of go over the generic definition of stop orders and how they work. So, because it can be a useful tool, it can be something that people overuse and get stopped out of things accidentally and stuff like that, but important to know how they work. So, regular stop orders convert to market orders once the stop price is hit. So, if you own a stock and you put a stop order, so say you own DraftKings here at $61.53 and you put a stop at $58. Essentially, if the stock price drops to $58, it will convert that stop order to a market order to sell that basically at the first price that the brokerage can procure the sale for. So it could be, you hope that it will happen, really soon, as long as there's not just like a drastic fall. But yeah, so that's essentially how a stop order would work in the selling. So you can also buy stop, which is where you'll set the price above the current price, assuming you either own it and want to buy more or don't own the company. You can put a buy stop for it to place a market order as soon as the price hits that. Which the most common way to use a buy stop would be if you're like waiting for a company to basically show upward momentum. If you're wanting to see the company, say DraftKings, you're like, I'm not sure where this is going, but if it went above $70, then I'm like really sure that it's moving in a forward momentum kind of upward trajectory. Then you can put a buy stop at $70, and then it will fill as close as it can to that once it hits $70. A buy stop must be above the current price. A sell stop must be below the current price for the order to actually go to be placed. Stop limit orders can be placed that will only allow the order to fill once the stop is hit and then it has not reached the limit. So again, in that case of like a $70 buy stop, you could put a stop at 70 and then put a limit at 72. So as long as it's not just an exponential move up, you don't want the market order to go through at $82, or something like that crazy if it's jumping up. But so you can put a stop at 70, put a limit at $72, and it will fill it as long as the brokerage can fulfill the order between that 70 and 72 range. Similarly, on the sell side, so you could put a stop at $58 and then put a limit at $55, and it won't fill it for you unless it can get it between that 58 and 55 price as a sell. So. But a sell stop or a stop loss is probably the most common use for a stop. Basically, you own the stock and you've made some profits, or maybe you haven't made any profits, but you're hoping that the stock continues to go up, but you're not sure, and the market's showing some volatility and there's some consolidation going on, and you want to either guarantee some locked-in profits or limit your losses if you're already negative. And so you can put a sell stop, commonly referred to as a stop loss, that will trigger for that to sell. That way, again, you either lock in some earnings and make sure that a winning trade doesn't turn into a losing trade, or, if you're already in the negative, just making sure that you don't turn, a 5% loss into a 10% loss. And then I think I already said this, but buy stop orders are most commonly placed when you're waiting for a stock to show upward momentum. So that's kind of the other side of the stop loss versus a sell stop. So stop orders.